Debt for equity swaps, a way to extinguish liabilities. A debt for equity swap is a financial transaction in which a company or debtor exchanges its debt obligations for equity ownership in the company. This usually occurs when a company is facing financial distress and is unable to meet its debt obligations. Here's a simplified explanation of how it works. 1. Financial distress. The company is struggling with a high level of debt that it cannot repay using its existing cash flows or assets. 2. Negotiation. The company negotiates with its creditors, lenders, to restructure the debt. Instead of repaying the debt in cash, the creditors agree to convert a portion or all of the debt into equity. 3. Equity issuance. In exchange for forgiving the debt, the creditors receive ownership shares, equity, in the company. This makes them partial owners of the business. 4. Debt reduction. The company's total debt is reduced, easing its financial burden. It may also result in a more sustainable capital structure. Number 5. Ownership changes. The creditors who participated in the swap become shareholders in the company. The extent of their ownership is determined by the terms of the swap. This financial maneuver can be a strategic move for both the company and its creditors. For the company, it provides relief from immediate debt obligations. And for creditors, it offers an opportunity to participate in the company's potential future success through equity ownership. It's important to note that debt for equity swaps often happen under complex legal and financial conditions, and they may involve regulatory considerations. Legal and financial professionals are typically involved to ensure the transaction is executed properly. A certificate of beneficial interest is a document that represents a person's ownership or interest in a trust, partnership, or other entity. It signifies the holder's right to receive benefits or income from the entity. These certificates are commonly used in trusts or investment funds. Here are key points about certificates of beneficial interest. 1. Ownership interest. The certificate indicates the holder's ownership interest in the underlying asset or entity. In the context of a trust, it represents a beneficial interest in the trust property. 2. Income distribution. Holders of certificates of beneficial interest are entitled to receive a portion of the income generated by the trust or entity. This income can come from dividends, interest, or other sources. 3. Transferable. In many cases, these certificates are transferable, allowing the owner to sell, assign, or bequeath their interest to another party. 4. Legal structure. Certificates of beneficial interest are often associated with entities structured as trusts or partnerships. They provide a way to divide beneficial interests among various beneficiaries or investors. 5. Privacy and flexibility. In some jurisdictions, the use of certificates allows for privacy and flexibility in the distribution of beneficial interests, especially in trusts. 6. Trusts and investments. In trusts, beneficiaries may hold certificates representing their beneficial interests. In investment funds or partnerships, investors may receive certificates representing their share in the entity. It's essential to understand the specific terms outlined in the document and the legal implications associated with holding a certificate of beneficial interest. Legal and financial professionals are often involved in structuring and managing such arrangements. Yes, certificates of beneficial interest, CBI, can be used in a debt for equity swap transaction. In a debt for equity swap, existing debt obligations are exchanged for ownership or equity in the company. CBIs can represent the equity or ownership interest that the creditor receives in exchange for canceling or converting the debt. This type of transaction is often utilized to restructure a company's capital, improve its financial position, or address liquidity issues. However, it's crucial to carefully structure and document such transactions and, if necessary, seek legal and financial advice to ensure compliance with applicable laws and regulations. While certificates of beneficial interest, CBI, are not typically used as a direct form of barter, they represent ownership or interest in an entity, such as a trust or business. If both parties involved in a barter arrangement agree, they could potentially use CBIs as part of a broader barter agreement. However, it's crucial to ensure that such arrangements comply with relevant laws and regulations, and it's advisable to seek legal advice for any unconventional use of financial instruments. GAAP consists of a common set of accounting rules, requirements, and practices issued by the Financial Accounting Standards Board, FASB, and the Governmental Accounting Standards Board, GASB. GAAP sets out to standardize the classifications, assumptions, and procedures used in accounting in industries across the U.S. The purpose is to provide clear, consistent, and comparable information on organizations' financials. Accounting for transfers and servicing of financial assets. A transfer of financial assets, or all or a portion of a financial asset, in which the transferor surrenders control over those financial assets, shall be accounted for as a sale to the extent that consideration other than beneficial interests in the transferred assets is received in exchange. The transferor has surrendered control over transferred assets if and only if all of the following conditions are met. A. The transferred assets have been isolated from the transferor, put presumptively beyond the reach of the transferor and its creditors, even in bankruptcy or other receivership, paragraphs 27 and 28. B. Each transferee, or, if the transferee is a qualifying SPE, paragraph 35, each holder of its beneficial interests has the right to pledge or exchange the assets or beneficial interests it received, and no condition both constrains the transferee or holder from taking advantage of its right to pledge or exchange, and provides more than a trivial benefit to the transferor. Paragraphs 29-34. C. The transferor does not maintain effective control over the transferred assets through either 1. An agreement that both entitles and obligates the transferor to repurchase or redeem them before their maturity, paragraphs 47-49, or 2. The ability to unilaterally cause the holder to return specific assets other than through a cleanup call, paragraphs 50-54. Extinguishments of liabilities. A debtor shall derecognize a liability if and only if it has been extinguished. A liability has been extinguished if either of the following conditions is met. A. The debtor pays the creditor and is relieved of its obligation for the liability. Paying the creditor includes delivery of cash, other financial assets, goods, or services, or reacquisition by the debtor of its outstanding debt securities, whether the securities are canceled or held as so-called treasury bonds. B. The debtor is legally released from being the primary obligor under the liability, either judicially or by the creditor. A personal bookkeeper can play a crucial role in a debt-for-equity swap transaction by managing the financial records and ensuring accurate accounting. Here's how a bookkeeper can assist. 1. Record keeping. Maintain detailed records of the debt-for-equity swap transaction. This includes documenting the terms of the agreement, the amount of debt being converted, and the corresponding issuance of certificates of beneficial interest. 2. Accounting entries. Ensure that accounting entries accurately reflect the conversion of debt into equity. This involves making entries to account for the reduction in liabilities, debt, and the increase in equity. Proper classification in the balance sheet and income statement is essential. 3. Compliance. Work with the company to ensure that the transaction complies with accounting standards and regulatory requirements. This may involve consulting with external auditors or accountants to verify the appropriate treatment. 4. Financial reporting. Assist in preparing financial statements that reflect the changes resulting from the debt-for-equity swap. Transparency and clarity in financial reporting are crucial for stakeholders, including investors and regulatory bodies. 5. Communication. Facilitate communication between relevant parties, such as the company's management, legal advisors, and external auditors. Clear communication is vital to ensure everyone is on the same page regarding the accounting treatment of the transaction. Remember, while a personal bookkeeper can handle the day-to-day accounting aspects, it's advisable to involve financial professionals, including accountants and legal advisors, to ensure the transaction is executed properly and in compliance with applicable laws and regulations. Financial asset means cash or a contract or instrument that conveys to one entity a contractual right to receive cash or another financial instrument from another entity. Consider hiring a personal bookkeeper as a foundational step in your journey toward financial success. Schedule a free consultation by clicking the link below.